Okay, so good afternoon, guys. Um, let's start today's session.
Yes, sir.
Yeah,
Good afternoon, sir, again.
afternoon. So, we'll start with some theory this in this session. Before like we continue on whatever we have been discussing for the past few days, last one day, in fact, not few days, I guess. Yeah. So with our knowledge in from in quantitative finance, the things that we have discovered yesterday. So the main thing that we covered in yesterday's class was the portfolio theory, right? The main, the main important thing about the portfolio theory. Now let's uh, talk about another very important aspect of portfolio theory, which is the risk return model and the portfolio optimization, right? Now, what do we mean by that? We basically what we have looked at so far are what the expected returns are, right? But do we expect the actual returns to be different from what we expect it to be? And that is what risk is, right? Risk represents the chances that the actual return is different from what we expected it to be. The greater the portfolio volatility, the greater the risk. And now what is this volatility is all about? We talk about the portfolio, the volatility in the market, right? So volatility is basically the amount of risk or uncertainty related to the size of the changes and the value of the security, right? So we want to optimize our portfolio in a way that we reduce the volatility in our portfolio. So basically there are two things we need to consider. Um, so the first important thing is the variance, right? Now, what is variance? The next thing is the covariance of the between the securities. So the two important things are the variance and the covariance. Now, what is variance? Variance is basically how one stock behaves with respect to the market, with respect to, right? So basically it is type of standard deviation. Means variance is basically the square of when you square the standard deviation, you get the basically the variance in between the stocks. Now with this little bit of background, let's go about I don't want to get into much depth into the actual mathematical calculation for our variance covariance. I hope you may have done it, and you must have been exposed to like the calculation of the covariance matrix between in your portfolio, or variance calculation of variance standard deviation based on that calculation of the expected return. Now where I am coming at, how do we actually minimize the overall variance, the volatility in our portfolio, so that when the market actually undergoes a change, your portfolio value doesn't is not affected a lot. You need to make sure that when there is a downturn, your values will be impacted. So with this knowledge, let's go back to our R studio, right? I'll share my screen. There are two R studios. Good. So we reached up to this stage yesterday where we calculate the portfolio where we had created the portfolio specifications, right? I was trying to back test. Okay. So if you remember in our yesterday's class, we had imported all these libraries like mode. I hope everyone has imported these libraries, have been successful in getting these libraries in their system. ROI.plugin and all of that, right? Let's continue our session from there. I will read on that because I think it has gone away from my machine. Good. So so you remember we first used these seven stocks, and from the closing prices we calculated the basically the portfolio returns uh, using the function called as ROC. Uh, so let's see how the portfolio returns look like. So you see, we have the portfolio returns for all our seven stocks here. Okay, that's fine. Right. So we have so using the function called as ROC, which is an inbuilt R function. Um, if you want to actually see what is a particular function's definition, you can do this. And when you click on ROC, it will be rate of change. You can see the definition of any function by this writing question mark followed by the function definition, and what it exactly does you will be able to see. So you see what are the different parameters it is taking. It is taking number of n, is taking the type of variable which is continuous or discrete, but we need not pass any did not pass any parameters to my this ROC function. I just called my portfolio prices here. So essentially what I do, you may pass the additional parameters given the necessity, but that will be dependent. It need not have, we can just pass the end prices or the portfolio prices only to our portfolio. See, the arguments are price, volume, etc., whatever for which we want to calculate the rate change or the basically the rate of returns. Here it is rate of change or rate of or momentum, right? That is what ROC function does. N is the number of periods to use. We use, if we want to use, I use when I don't pass this number of periods, then it will take the entire period. I didn't so by default it has taken the entire period, and from entire period I mean from 2016 0103 till date, it has taken all the ROCs. Type, yes, if your variable is continuous, you have to mention it, but right now we didn't have any, we had normal values, right? So we didn't need to uh, do anything on that. But similarly, you can like there are many other things. That is one part of it. Now, what I did is I created a portfolio specification function here. If you will remember, I created a portfolio specification function where I'm calling all the portfolio returns value. The portfolio returns is having the returns for each one of my stocks. Now let's go ahead. The next thing that we want to do is we want to optimize our portfolio, right? Or let's um, we will see about optimization. Let's talk about Now, let me show you something actually. I think I can show it here itself. I'm just using it at a notepad level. So when after creation of a portfolio, is the creation is the first step, right? Uh, it takes by default. Portfolio creation is the first step. The next step that you want to do is there is something called as add constraint. What do you mean by constraint? We will come to that. Now, let us say you have a portfolio, right? And you want to specify how much to invest, what is your volumes to invest in which of the stocks, right? Right now we have equal investment in each of the stocks. But say suppose I want to constrain, I want to limit it. I don't want to extend it. I want to say only get me 5% in my Netflix stock, 10% in my Amazon stock, 25% in my Google stock. And that constraint I want to provide to my portfolio. I have to use something called as constraint. We will look at in depth the different type of constraints that are there when we are trying to create our portfolio. But let's first do one of the processes. Uh, so that is a constraint. The next thing is called as objective. What do you mean by objective? Again, objective is also very similar to your constraints. Objective is where you are trying to define what is going to be your expected values for your portfolio. How much is the long position, or whether you want to keep the short position. What is your objective in the portfolio? To maximize your return, to reduce volatility, to reduce variance, um, or to so basically it is a risk return model. Means you have to decide what is your objective. Objective defines how risky your profile is, based on which your risk taking ability will decide your portfolio's nature also, right? So that is where you specify your objective. In fact, there is another thing called as the return model, but that's something that we don't use a lot. But in fact, these three are the most important in our um, entire analysis of or creation of portfolio. From here, what we do is we optimize our portfolio. So it once we optimize our portfolio, what we get an optimized model. Clear? So this is what is basically a. Now let's see how we do it in actual practice. So we created our portfolio specification. Now let's go ahead and create our um, constraints. So let's uh, create our first constraint. And the first constraint that we will create is called as the weight sum. So you can see there is a function called as constraint. And what we will specify inside port F, our portfolio specification, and then the type of constraint that I want to use, which in this case is weight underscore sum, right? Now I will explain what weight underscore sum means. Let me complete the sentence. Minimum underscore sum equals to 1 and maximum underscore sum equals to 1. Now, what does this mean? What this constraint actually means is that I want my portfolio to be 100%. Means all the portfolio stocks, uh, the weights of the individual stocks, when we add up, it should sum up to 100%. Means I am not leaving out anything from our portfolio. I am creating a complete 100%. I am utilizing the 100% of my investment in my portfolio, in one of the portfolios. So the summation of my the weights of the stocks become 1 or 100%. So that is one constraint I want to keep. Now let me see what is the other constraint that I want to add. The next constraint that I want to add is a box constraint. Now let's see what is a box constraint. Type will be equals to box. In box, what I want to add, minimum equals to 0.10 and maximum equals to 0.40. Now, what does this mean? This line means that I want to add a constraint where I want to specify that my stocks, weight of none of my stocks is less than 10%, and weight of none of my stocks is more than 40%. So I want to add this constraint so that this weights of each one of my stocks is in the range of 10% to 40%. It can be anything in between. So based on the best possible available values, R will decide what is to assign to each one of them. But it cannot assign anything more than less than 10% or more than 4% given this criteria, right? Now let's see about the next thing that I want to do is I want to add an objective function. Now, what kind of an objective function I want to add? Okay, let's see. Here we have to, here you see the very, on the returns. The objective function is on the returns, and I want to give something called as mean. So I have an objective function for my returns to be in and around my mean. Means what I'm saying is my returns cannot be the overall, cannot be less than my overall mean or the market returns mean, which is, and I want to add another objective function here. Let me see what objective function I want to add. That the another objective function that I want to add here is based on, let me say I want to add another objective function based on risk. And name will be equals to standard deviation. Standard deviation. So I added two objective functions around my return and my risk, right? So now the next step that I want to do is, let me see. I want to create my optimized portfolio now, right? So let us create our optimized portfolio. How can we create our optimized portfolio? The optimized portfolio will be, we will invoke a function called as optimize.portfolio. Now let's see what is that. Optimize.portfolio, it has come. And now what are the parameters that I am going to pass here? The first parameter that I am going to pass here is the portfolio returns. The second parameter that I am going to pass here is portf. Now let's do one thing. Uh, Let us see this portfolio optimize.portfolio. What is their uh, parameters that it takes actually, right? So the function, now you see this definition, what it is giving. The function aims to provide a wrapper for the constrained optimization of the portfolio. Means it creates basically an optimized portfolio. So what are the arguments it takes? Let's see. The const R, which is the normal constraints, the optimized method. And now if you remember, it is either ROI or optim random. These are the different optimized methods you have that is present in R. Now I'm not getting into the mathematics of each one. Each one of them has their own mathematical derivations. It will be pretty uh, uh, hard to use that. Anyway, next thing is trace, search size, how many portfolios to test. So basically, the default is 20,000. You will have to say. Optimized portfolio, this is very important. So it will do so when we are giving these constraints and these objectives, what will happen? It will try creating different portfolios based on these constraints, right? Because say it will assign, it can go on assigning 0.111 in one, 0.12 in another, 0.23 in another. Uh, so you have multiple different combinations, right? But you want to limit it to a certain level. So by default, when you don't give a search size, then it takes 20,000 permutation and combination of the portfolio sizes it creates. So hence, that is what is this function doing here. Trace and RPM, then portfolio it takes, objectives, everything it takes. So based on that, it will create n number of portfolios with different weights and see which is having the best return. So let's see what are the portfolio returns. And then we have the port F. I want to pass my, now when I'm passing port for this port F, it contains my, what it contains my constraints, it contains my objectives, right? Now I have to, as you said, optimize method, which method I want to use.
So just 1 minute, sir. Just a minute.
Yeah.
You're saying you are given two constraints, return and risk. So have we, is it default that we have to minimize the risk and maximize return, or?
It depends upon your your risk taking ability, right?
So a constraint has to be, it has to minimize the risk and maximize return. So is it by default there, or?
Constraint is not for minimizing risk and maximum. Objective is for
Objective.
Objective is for your risk and return. So what I am saying is that return should be around my mean and risk should be dependent on my standard deviation.
Okay.
It should not be much. Means what it basically does is if the risk we have there is a portfolio standard deviation which will be automatically there, which will be created based on the relationship of each of the stocks. I don't want, if the objective is to if the what this function will do, if there is a 5% deviation from the actual standard deviation, then it will reject that portfolio. My overall standard deviation should not be more than given threshold, and the default threshold is like plus minus 5% when we are not having, when we are not specifying the threshold. So your return and your risk should be in between plus minus 5% of your overall or your overall value that you have. Within that, you have to maximize what is the best possible combination of your weight is what you will be taking. Clear? Any questions for that?
Yeah, it's fine, sir.
Yeah. So let's now it had another thing called as optimized method, if you will see here. Yeah. So optimized method can be any one of these: D-optim, random, or ROI. Now I have all these libraries already here. D-optim is there, ROI is there. Let's use ROI. ROI is there. So basically, it is in one of the methods of optimization, means how it selects the portfolios. It's like it doesn't is not much different. Actually, we could have used others also. Now trace equals to true. Trace equals to true. Now what it says, true or false. True will attempt to return additional. It says, yeah, additional portfolio searches. So we have invoked this function called as optimize portfolio. And now let's see what it let's run it first. Let's see whether we ran it up to here. Portfolio returns. This one, portfolio also we ran. We didn't run the constraints and the objectives. So let's run it. Okay. So constraints and objectives are added to our portfolio. Now let's create our optimized portfolio. Good. It got created. Now let's see what it is giving. It's a little vague in the sense it has, if you see, let's do this actually. Print, print OPT quote. Now let's run it. Okay. So you have got a mean and a standard deviation of your portfolio. And you see the weights that are being assigned. Interestingly, Facebook, Apple, Amazon, Netflix, and Google, it has assigned a weight of 0.1. And for SQ and NVIDIA, it has assigned a weight of 0.2036 and 0.2964, means 29, approximately 30%. 20% is approximately for this. And overall, others have been assigned 10% each. If you see, all these weights will sum up to 1 because of the constraint that we had specified. If you use this plus this, it will be 1 because of this constraint. And because of this constraint, we have nothing which is less than 0.1 and nothing which is more than 0.4. Good. Let's print our chart underscore series. Right. And what I want to basically, I don't want to use charts. So let's say chart weights. I want to see weights because that is what is the most important thing that we did, right? Let's run it. Now you see everything is 10% all the way up to Google. And as soon as it SQ and NVIDIA, it touches your 30% approximately. So it's just a way to visualize. In fact, even the print function told us the same thing. Now let's create our efficient frontier. I hope you all know what is an efficient frontier, right? Uh, the most optimized weight, what is the expected returns? So the function that we use is called as an extract efficient frontier. We'll use this our optimum portfolio. Uh, we have to use something called as match column equals to standard deviation. When match column equals to standard deviation, and uh, no, actually, let's see this what it is actually. Extract efficient frontier. So if you see extract efficient frontier, extracts the efficient frontier from an object, right? And what are the object here is our optimized portfolio. Match dot column. What is this? String name of column to use for risk, right? Horizontal axis match dot must match the name of an objective measure of the objective measures or optimum values slot in the object created by optimized portfolio. So that is our standard deviation. And number of portfolios, we have to specify how many portfolios we are using. 10 portfolios. Let's take it 25 here. Not more than that, otherwise our system will hang. And risk aversion equals to null. Means we are not risk averse. Now let's run this and see what it gives us. Before that, let's see what is risk aversion. So risk aversion basically is, if you give a value, what it will do is it will try to use a different set of combination of your, means your, efficient frontier is basically the most optimum value of your portfolio. It gives you the graph in which shows you the most optimum value of your portfolio. Let me draw it and then we will see. Say suppose, let's visualize it like that. You have let's take two stocks. You have stock A and stock B, right? Now what happens is, based on a given weights of each of the stocks, your returns are going to be decided, and you also know the standard deviation, the variance in your portfolio, right? Um, Based on the standard deviation, you will have for each level, each standard deviation, you will have different returns. The value of your returns will be different for each standard deviation. Means, so what will happen is, if the more the standard deviation means, you are ready to take more variance or volatility in your portfolio, right? So what will happen is, the more the variance or the more the risk that you're ready to take in your portfolio, your expected rate of return is also going to go higher, but at the same time, your expected loss is also going to go higher, right? So you have to balance out your, based on a given standard deviation, you have to balance out what is your most optimum portfolio. And efficient frontier tells you nothing but the point at which your portfolio is most optimized, not that it gives you the position at which the portfolio gives you the max return. No, it doesn't do that. Your objective is never in a financial market to only to maximize your return. You have to cover your back. So that is one of the most important things. Now let's draw this. So I think it has been done. Now let's chart it out. Now there is a, in order to chart it out, we have to give some parameters. Let's create our chart. dot efficient frontier. Here we have chart dot efficient frontier. What are the things that, what are the parameters that we want to pass? First, your efficient frontier value. Actually, we want to see what EF is going to give you. Let's print EF and see what it gives. Okay. So constraints, it has taken into consideration objectives, mean and standard deviation, and it has created only, so it has given your, it has not given any values. So that is why we want to chart it. Basically it is does not giving you values because it's a curve. It's a basically a curve based on which you have to decide your point. Now let's plot that curve. Match dot column, we will give standard deviation, right? And then we have to give n portfolios, which we have already given. 25. We want to restrict it to. Now let's limit our x limit also to null, and y limit also to null. Means I don't want to basically restrict anything because efficient frontier is basically, it's like a curve, right? We don't want to give any uh, restriction to it. So there is something called as, we want to give cx dot axis. We want to give a point A will be enough. Point 8 is generally enough. Element dot color, let's say gray. Now we want to give the um, name to our graph. Efficient frontier. Um, Now let's, it has also tried to give some text formatting also, because r equals to 0. We can pretty much use this entire thing every time that we want to use tangent non-line. We want to also, now we'll see what is the tangent that we are talking about. These are the standard basically for the graph that we do. We don't need to bother that much about chart. More or less, this will be same for most of your calculation. Most of the other times that you will create your efficient frontier, it is going to be the same. Labels dot assets, that also you can make it true. And then pch dot assets. This also you want, this is basically 21. And let's put the cx dot assets. So that's right. Mhm. Now you see your efficient frontier. Your efficient frontier is this line. If you will see the curve that you are seeing, right? That is your efficient frontier. Now, what could be your most optimum portfolio? Now you see, based on the standard deviation, the higher the standard deviation, the higher the returns that you're going to get. You're getting, right? Your mean is increasing, means your expected, your return is increasing. But is it true that you, as per this graph, you have to take the highest point, uh, the highest standard deviation where this graph is will show you. That will give you the maximum return. But will it give you the most optimized return? No. You have to, will have to create the most optimized return is a tangent to this curve. And that based on your risk taking ability, you will have to decide what is going to be your most optimum point at which you you have to take your uh, the values that you want to take, which will be mostly around this value. If you'll see, um, where the curve starts to get flattened out, that is a point where your most is your most that is your most efficient frontier. That is the standard deviation and the mean corresponding to it. So this is your efficient frontier. Now these are generally uh, the patented values use that we use basically. So you can very much use it for all other, every time you want to create, and you can change some things, and few things it's only going to change the graphics of the output that you are going to get it. Not much that you will be changing as such into it. But yeah, that is what is your efficient frontier is. Huh. Now you got your the mean and the standard deviation corresponding to your most optimized portfolio, right? Basically, EF was for your optimum portfolio, and what is your standard deviation from the, you can choose basically from the efficient frontier, what is the standard deviation you would like to. Now, let's get into some theory. Um, so, the correlation and the covariance measures, basically they indicate the strength of the relationship between two assets. Are they moving together up and down, or they are moving in different directions? That is something we might be interested when analyzing a portfolio. The correlation basically between assets A and B, uh, you expected return between two portfolios. Are every one of us know the expected means do we have the mathematical background of what is the expected return of a portfolio? You know, let me share another screen. Let me open a bit of a theory. Sure. Hope you can see my screen. Now, what does EMT or the efficient market theory actually mean? Let's go back to the time when the stock price movement was basically given by the random walk hypothesis. Now, in 1900, as you see, there is this famous French mathematician Louis Bercaglier. He basically started this random walk hypothesis, and which has been continued by many other theorists, many other mathematicians in the later half of the things. Now, what does this random walk theory actually mean? Random walk basically is you are taking historical data into account. Basically, you are say summing up last few periods of your stock prices and expecting the value of your stock price to remain the same as part of your forecast. Say, so n you can sum up n period, n number of, say, suppose you want looking at daily returns. So, and so you can go on taking last 3 days as a time period. So that will become three moving average. Basically, it's part of the moving average. So random walk is means there is no absolute relationship between it. Stock movement is what it's saying. Now let's see what is the basically here. The expected return depends on your standard deviation. If the standard deviation is higher and the expected return is the same, then the one with the lower standard deviation is your more dominant stock here. That is what it says. Then we have many things called as diversification, so on and so forth. So I am not getting into much into the efficient market theory. I just want to show you what is the formula for your risk of a portfolio. So the risk of a portfolio is simply weighted value of the two assets. XA sigma A, sigma X plus XB square, sigma B square, plus 2 times XA, XB, X sigma A, sigma B, rho AB. What is sigma A and sigma B? It basically is the standard deviation of the asset A, and sigma B is the standard deviation for asset B. Rho AB is the correlation coefficient between the two assets, A and B. Right? A perfectly positive correlation will have rho AB equals to 1. Otherwise, it will have some value. Means it is correlated, but it is not. Zero correlation between will mean that rho AB, there is no relationship between the two stocks. So your formula will essentially become here XA sigma A square plus XB square sigma B square. It will not be, this rho AB will be equals to 0 in that case. And there is no correlation is equal to 0. So here it is, this is your efficient frontier here. So if you see here, your portfolio for your stocks which are not correlated, the overall return is the weight times XA square plus your the standard deviation square plus the second returns of the second plus this standard deviation square. Negative correlation, again, it will be -1 for a perfectly negatively correlated between the two assets. Right? So that is your efficient frontier graph. You see, this is the point where which is your most optimum portfolio. Here is M. If you see after that, why is M you consider as the most optimum value of your portfolio? Why is it so? Can anyone guess here?
Standard deviation is minimum and expected return is higher.
Exactly. Exactly. Perfect.
Because the above we got, though return is higher, but standard deviation is increasing more higher.
After M, if you will see, for any additional unit of standard deviation, or basically for any additional unit of risk that you are going to take, your returns are very minimal. Means the graph is getting flatter and flatter and flatter. So no point in taking risk when your returns are not going to be more higher, right? Means it is absolutely ridiculous that to take that there is, if you invest in one stock which is definitely going, you know that it is going to go down over the next few days of time, though it is a little bit higher now. It is something like that. So you're thinking that you're taking a big risk for a very less reward. It is not worth it. That is why this point M, after that, even for the more risk-taking investor, the M is the maximum point where he can go up to. After that, it will be a foolish decision to invest, means taking any decision after this point M. So that is the idea for the your efficient frontier graph. Anyways, I don't want to get much into the theory. Let's go ahead with um, our R studio. Somebody is
Sir, we can do it in Python also, na? Efficient frontier.
we can do it.
In Python also, na? We can draw the Python.
Yeah, Python has even more libraries in quantitative finance than R.
Okay.
Python has actually is one of now Python is used more for quantitative finance modeling. R started the phenomena with quant mode package, but who is Monotosh here? Anyways, okay. He's given a message, so I was just thinking. Good. Now we'll talk more about our constraints and our we'll talk about the different type of constraints that we are having in our the next thing that we want to do. Let me clear out everything so that get this one also out. So let's talk about a bit about the different type of constraints we are having. We'll talk about in this or okay, let me open another one and then sorry. Let's use another package called as now. Let's so these libraries remain your constant. So whenever you want to do any analysis, the first thing that you will be doing is by default invoke your libraries, and this becomes your standard set of libraries that you can use for almost, I will say 90 to 99% of your quantitative finance modeling in R. 95%. It doesn't, there are many others also, means if you want to go deeper and deeper and deeper, yeah, means overall we can say that this is what it is. Now let's use one of our R packages, R data set, which is called as EDHEC. We can directly invoke EDHEC in our environment using this. So this also has a lot of financial data. And let's call this R, and we will store column 1 to 6 of this data, EDHEC data in our environment, right? Basically 1 to 6 columns we want to store. So let me see. It created. Now let me see what it is. Yeah. So if you see, EDHEC also has the price of various different kinds of your stocks. Some of your some convertible are arbitrage, CTL, distressed securities, some kind of your financial assets. It has the data. This is an R inbuilt data set that we are using. Just wanted to introduce you to a new data set. You can call any other platform also here. There are different ways to call it. The most efficient, the most easiest way that you can, or the most efficient way in which you can get your data is by reading through a CSV file. How that makes it more relevant actually, because you can select the data for the time period you want, for the from the platform you want, in the way you want. So you can do your initial modeling in Excel by cleaning out your data to a certain extent and then bringing it here. But yeah, if your data is very huge, Excel may not be able to handle it. Then you will have to do your data cleaning and your data manipulation in R rather than in Excel. So so that's a different topic altogether, like how we handle data and how we clean data in R. So there are a number of steps that we do when we are dealing with large data sets. I don't want to get too much into it, but let's see. Column names of R. This is where I will give my few of the column names that I have. CA. I am basically, what I am doing is I am renaming the columns that are in my data set. Because if you had seen, the column names were pretty huge, and if we try to use them in our analysis, every time we will have to write a very huge name. That's why we are here. What we are doing is we are renaming them in our data set. Right? It's nothing. Just rename the column names in your data set. So basically, it's as simple. And let's actually store it in a variable so that we can call the variable anytime. Okay. So let's initialize our portfolio. initializing our portfolio, we will use something called as our old function, portfolio.spec. And what we want to initialize here, funds. You can just check what is funds here. Funds is basically a variable which is storing column names basically. And we'll have to give assets to funds. Initialize. So basically, it has given a default weight, same weight to each one of my assets. If you will see the portfolio spec. So this is now we will create our constraints, that the different type of constraints that we will use. I will not cover 100%, but there are a huge number of constraints that there. Let's look at some of them. One thing that we already saw was right was there are two constraints which we have already seen. One is your weight sum, another is your box. So let's if you want to call box once more, we can call it. Box is one of your most used constraint. So that we use in our data set. Portfolio equals to it. Type equals to box. Equals to 0.05. Max equals to 64. Let's stop. Let's see another type of constraint that we are having. Weight sum, I don't want to use weight sum because then it will can the sum of our weights be equals to 0? What do you think? Can we have a constraint where we are specifying our weights to be 0? Can you think of a situation where the summation of the weights of our portfolio is 0? No? Well, whenever you are invested, what is, say suppose most of us have invested in one or the type or one or the different type of assets that we have, right? Now, whenever we have invested, what are the type of positions that we can take? There are only two positions that we can take, right? One is a long position, one is a short position. What is a long position? Or screen sharing is paused, you're saying. Okay. What is a long position? So long position is a position when you want to stay invested, right? When you want to stay invested, you are having a long position, basically.
Sir,
Tell me.
long position is when we buy first and we are going to be profitable after selling. And short is when we sell first and then we have to close the position by buying.
Correct, exactly. Means I was saying, means basically when you are in a long position, you don't sell it. Means you want to keep it for the time being because you expect the stock prices to increase in the near future. Short position is when the prices are going down and you want to like make a give a stop loss. So what basically here it is, we want to add a constraint. So our weights can be equal to zero also, given we are in a short position. So we can assign a negative weight also to some of our stocks. Means we want to release those stocks from our portfolio. When you assign a negative weight to a stock, it becomes, let's see, let's add that constraint and see how we can add that constraint. But that constraint we cannot add with this. Weight underscore sum equals to 0, max underscore sum. And let's not define this. We add this constraint. And then let me call these other things. We have not written our portfolio returns. So we can create a return. Anyways, we will see later on. We have not created a return object, so because only we are discussing. Anyways, so when you're giving min underscore sum equals to 0 and max underscore sum equals to 0, what is happening is we want the summation of our weights in our portfolio to be equal to 0. Means we have both long and short positions in our portfolio. We want to release the underperforming assets from our portfolio, then you give this kind of a constraint. Let's talk about another type of constraint, which is called as the group constraint. There is another constraint called as the group constraint. Now let's see what does the group constraint basically means. So portfolio equals to init, and then we have another type of constraint called as type equals to group, and you have to say equals to group, type equals to group, and then you have to list your names. How will you do it? Groups equals to list, and you have to create your group. The first group, list group A. Okay, now list group A we have to give what are the expected values in 1, 2, 3. Let's or say 4. Okay. And then what we want to do, want to give group B. Group B 3, 4, 5, 6 is equal to C. So the first 4 stock that you have are put in group A. The next 2 stocks are put in group 2 or group B, right? Here, what you have to do is you have to give your group mean and group max. Group underscore min equals to, let's say, C 0.1, 0.15. And let's say group underscore max is to, you will give 0.85, 0.55. Now let's see what it actually means. Here's another bracket which is just equals to okay, 1, 1, 1, 1, 1. Let's go back. Hmm. Now you see what it is. This is going. The first 4 stocks in your portfolio, what is going to be the value for them? The maximum value that it can take is 0.1. Sorry, the minimum value that it can take is 0.1, and the maximum value they can take is 0.85. The first 4 in your group. Similarly, the last 2 in your group can take, the summation can be minimum 0.5 and the maximum is 0.55.
मेरे तो वैसे सच्ची में बंजी जंपिंग का मन करने
Participants, I think from sir's side, there is some technical glitch. I think he's going to join us back in a few seconds. Right now, sir is not in the meeting, so I think due to some network issues, he is like signed out. He'll join back in few moments. Dear participants, Ranveer sir is going to join us back in a minute or two. So kindly be patient.
Sorry guys, my there was a power breakdown here, and
No issues, sir. No issues.
so let's continue. I have to use a different power switch altogether. So let me share my screen. Okay. So here we were. I think our last did not get saved actually. Not a problem. Succeeded. Yes, let me use this one. Okay. So that was one of the ways. So we saw the addition of our um, the constraint called as the group constraint in our library. Now let's see what few more type of constraints that we use in our portfolio. So I will not use these. I'll directly, I think we did up to these. Let it run, I think. It's connected. Off. Is it? It's loaded. Let's use a different terminal. I think it is this terminal has got hanged. Let's see if this is okay. Spec. I will just share my others. Yes. Close this one. Switch yourselves to a different options. Okay, good. So here we created these front names that we had talked about. Now so that was group was one of the functions that we had used, right? Now let's see how different any other type of constraints that we think that we can add. There is another type of constraint that we can add, which is called as, let us say, pspec, which is called as, let's type equals to dollar neutral add dot constraint, and we can call it portfolio equals to pspec and type equals to dollar neutral $_neutral. Now let's see what this spec is doing. Portfolio equals to pspec. This. Argument in is dot portfolio. There is one. Oh, it is called as active. This type is active basically. PSPC. V. No default. I think there is a, we have to give initially this other constraints also in order to not fun name. Let's see this. Yeah, we have these as the, so 0.25 weights has been assigned. Here I had taken 4 columns. Active is what? Dot constraint portfolio equals to, oh, the spelling is wrong. Portfolio. Now it will work. Yeah. Now you want to, so what it is doing here is, this is another way to, in which we are giving a weighted sum equals to 0. This is another type of constraint where we are saying that it is an active control. It is active means we have a fully diversified portfolio. So the sum of the weights is equal to 0. That is, in that, in other words, we can means, you remember we had given in the previous, where we had said weight and weight underscore sum equals to 0, where we are taking both long and short position in our portfolio. This is another way to write it. The another way to write it is underscore dollar underscore neutral. This is the same as when we write it as active. What it means is we are taking both long and short position in our portfolio. It does both the things, do the same thing. So that is one way. Box constraint we have already seen. Group constraint we saw. There is something called as a position limit constraint, right? Now, if we want to specify the limits on the number of assets with non-zero, long or short positions, then we have to give a position limit constraint. What do I mean by that? Is add dot constraint just copy the first part, type is equals to position underscore limit. So this is another type of constraint. Here we have to give something called as how many long positions we are giving, comma, max and maximum short positions we are, number of short positions we are taking in our portfolio. So this will not make it necessarily our sum 0, but it will allow us to define the number of long and short positions that we are going to take. Now this is add is a spelling mistake. Yeah. So pspec now has all these values, right? Let's go to another constraint that we are having. There is a diversification constraint, means, right? Diversification in the sense, how much means what is going to be your target diversification, like how much is your, what is diversification? Diversification basically is used to reduce the volatility or the variance in overall variance in your portfolio, right? You increase the number of your different assets that you have in your portfolio. When you increase the number of assets in your portfolio, the risk your portfolio becomes that much lesser. But after a certain point of time, diversification is only for the namesake, right? Means, say suppose you are having, you're invested in 10 stocks with $1,000 each. Now you want to break up into further 10 stocks, and you want to allocate another $20 from each of your previous 10 stocks to the next 10 stocks. That is basically redundant, means your overall improvement in your values of your assets will not be that much effective. So diversification is also one of the ways in which you decide your portfolio limit, right? Now, so let's with this, let's go to our next topic, which is where we are saying we will limit our, we will talk about our capital asset pricing model and our Sharpe ratio, right? So let's create a new worksheet, and we will invoke all our different libraries in that worksheet also. Here we will use one more library, dplyr. dplyr. It's used for plotting and all of that. We'll see that. So mostly your ggplot and all of that, uh, advanced plotting libraries are part of your uh, dplyr package. We'll see that. So let's talk about, get back to our tickers. What are the tickers that this time I want to take? I want to take 4 tickers now from our previous only. And the first ticker is Facebook, Apple, Apple. Then we have Amazon and Netflix. Netflix. Okay. So we have these 4 tickers. We will assign a weights to them. And weights, let's assign it 0.25, 0.25, 0.25, comma 0.25. Here we are explicitly assigning weights to each one of our assets, right? We never did it before, if you will remember. Portfolio prices is equals to null. Now we will call our old function called as for ticker in tickers, right? Since we already have this function already, let me copy it from my previous, for the sake of time, I will just copy it. Same from 2016, I am invoking. And portfolio prices here, it is portfolio P is capital. R is case sensitive always, you remember. So I'm storing the closing price of these 4 stocks in my ticker library. And let's see. So what I did, so my portfolio prices object has been created. And you can see I have the closing prices for my each one of my 4 stocks in my records. So now we want to, basically our idea is to create the benchmark prices. Now we have to, now Yahoo has another library called as Pi, which gives the benchmark prices, right? Let's see what these benchmark prices mean. We can create our benchmark prices using this same function called as get symbols dot yahoo, and in get symbols dot yahoo we have to use something called as pi. So let's run it and then we will see. Now we can keep this as same. Periodicity equals to daily. Run it and see what is the benchmark prices that we are talking about. velocity equals to daily, cosine equals to false. It's correct, right? Is mistake. Maximals, not Yahoo. So, this is not there. Okay. Yeah. So it created our benchmark prices. Yeah. So this is the average price of our market, basically, you can say. A free market, this is the average price that we are taking. And against this price, what we will have. So basically, our idea is to go to the CAPM model. Now, what does the CAPM model tell us? Can anybody tell me what is a CAPM model? No one?
Capital asset pricing model.
Yeah, what it is basically? Okay, let's briefly go to that model. Not take enough time, but we will just briefly touch upon that model.
Sir, am I
Yeah,
audible?
yeah, you are audible.
Yes.
Yes, sir. Sir, CAP model helps the investors to identify in which script you can invest. So it is a concept of underprice and overprice.
Good, very good. So this is, if you can see the screen, I just have opened the kappa model like in one slide itself. So basically, so this is an equation that is used to identify the required return of an investment based on level or risk. Basically conveys there is a proportional amount of risk you need to take in order to achieve a certain return for an asset. So if you see here, the formula, the return of an asset is determined by the risk-free rate, the beta, the expected market return, and the equity market premium. So there is a risk-free rate. So if you want to get more in detail about it, you can um, study a bit more about the kappa model. I'm pretty sure that most of you know. So basically, there is a beta, there is a risk-free rate, there is a market return, and the benchmark prices in the market is what we are taking in order to calculate the market returns corresponding to our portfolio, and so that we can create our kappa model accordingly. So hence, so let's go to the so let's start. So we created our benchmark prices. Now let's do this. There will be some um, NA variables. So we don't want to keep the null values in our data, or in our benchmark prices, because whenever there is a null value in the benchmark prices, what will happen is, let me see if there is any. No, there is nothing. So that's perfect. Um, so let's calculate our benchmark returns. So benchmark returns will be basically, we will use our very old ROC, benchmark prices. Here, though we know the values are discrete, you remember we There was a thing called as type. We had seen last time, we have not used this. Let's use it this time.
Sir, our window is not open, I think. Only PPT is showing.
I couldn't hear you.
Sir, our window is not open, sir. Actually, only PPT is showing
Oh,
here.
the PPT is there. I'm sorry.
Yeah. Oh, no problem, sir.
Sorry. You can see benchmark returns now. I've used.
Yes, sir.
So if you remember last time when we were calculating the returns, we didn't use this function, type equals to discrete. We didn't use this argument in our function. But this time we are using. This time also we can omit, but for a change, I just use that function. So let's say column names portfolio prices. Portfolio prices. What column name I want to put for the portfolio? Stickers, basically the. Just want to rename. Let's see. Let's plot our portfolio prices. We have to give the legends. Legend instead of tickers. Good. So this is the plot of our portfolio prices. So where is our legend? Legend has not come. Legend is absent. Let's see. Anyways, that's fine. So basically, we can see all the four stocks that we have and what is the different prices. But that is not a very. So let's now we will have to calculate our CAPM equation. So let's see how we can create our CAPM model. The next thing that we want to do is portfolio prices. Any null is there? This is how you check your null values. There is no null values. So that is perfect. So your daily returns. Your daily returns basically will be your instead of benchmark prices, you will give portfolio prices. So I calculated my benchmark returns and I'm also calculated my daily returns based on my portfolio, right? Now let's calculate something called as our portfolio return. I want portfolio return. Now you see portfolio return. Let's see how we can do it. Return dot portfolio. Use that function called as return dot portfolio. Inside it, what we have to give our daily returns. Daily returns, and what we have to give is weights equals to weights. So we have already assigned weights to a function. So I want to see what is going to be my portfolio return. So let's see, we have this portfolio return. So you get your portfolio return for each one of the days that you have. Don't confuse between daily returns and your portfolio return. Daily return is something that gives you on your portfolio prices, but your portfolio return is something that is going to take into account the overall, right? So there is a difference between your daily return and your portfolio return. The portfolio return is what considers your benchmark prices and your benchmark values also. Based on that, it considers what is going to be your portfolio return on your portfolio. Now, let's create some charts. Chart dot, what we can use chart dot C is something called as CUM, cumulative returns. So I want to get a cumulative returns on my portfolio. So let me see how does a cumulative portfolio return looks like. So this is my cumulative portfolio return. It is all the way, it is going up and up and up and up. So I am happy with my portfolio because it's on the upward trend and not in a downward trend. Now I want to see the performance summary. Charts dot performance summary. In the performance summary, we have to give portfolio return. Now let's see how this performance summary looks like. So here you can see your performance summary. There is something called as drawdown. There is something called as daily returns. This is your daily returns. This is your candlestick. The middle one. Okay, this is basically nothing but your candlestick technical chart. The upper one is your trend or your time series. Over a period of time, how it has.
Sir, sorry to interrupt. Can you zoom it a little, sir?
Zoom it. It's max zoomed.
Okay, sir. Okay, sir.
No problem. You are not coding with this time today. Okay, I will send you the code today. What you do is everyone should practice whatever we have done today,
Yes, sir.
isn't it? Everyone will try to replicate everything that we have done today and tomorrow's initially we will cover whatever we have done today. We will see that everyone has been able to replicate that much, right? I don't think there is a more option for a zoom. So I was like, basically what we have to do is you have to take a print of this. Normally we take a A3 size paper print, and then you can see in detail what has happened. In laptop, or you have a big screen monitor, then it will be very useful actually. You can, if some of you have in laptop, it is not very obvious actually.
That is okay, but I think you can increase that window size, no, sir, by dragging.
Yeah, we can do that. Right.
But now it is okay, sir.
Now it is fine. Anyways, it's a homework for you. Let's see. We can do that later. That's fine. We have to create our CAPM basically. So the formula that we will use for CAPM is called as, let's see, CAPM. In fact, CAPM we directly cannot use CAPM dot beta. We have to pass portfolio return and we have to do benchmark return. Now we are 0.035 with respect to the market. How has been? So basically there are 250 days trading days in a year, and 0.0355 is my risk-free rate of return. That is what 3.5% is our risk-free rate of return. That is what we are factoring it here. So what it takes, let's see here quickly. CAPM.beta. Now you see what are the arguments it takes. RA is your portfolio's return. RB is your benchmark return. What is there in the market return basically. And RF is your risk-free rate. So this benchmark return is available in Yahoo, and this risk-free rate we are taking at random average. This 3.5% is for the entire year as the risk-free rate. That's why we have divided it by 252 to get per day's risk-free rate. It has to be on the same, because as we know, every of our calculation is happening per day, right? It's our daily return. Even our portfolio return is based on daily returns and not on monthly return or yearly return. We can have that, but right now we have daily returns only. So let's run it. So our CAPM beta is 1.05, or your CAPM model gives me 1.053, which is pretty good actually compared to our overall market, which is decent, not very good, I will say, but it is pretty decent. Let's calculate our Sharpe ratio. One more thing. What is Sharpe ratio? Anyone knows? What is Sharpe ratio?
It is a measure of risk versus return.
Correct, correct. Let's. I will quickly go to that slide also. Let's mark it null. So the portfolio returns that it is giving us is approximately 6.6%, which is much more than the market return. So basically it is. Now let's go quickly see the what is the Sharpe ratio. So Sharpe ratio, what it is and why is it important? This ratio describes how much excess risk return you are receiving for the extra volatility that you endure for holding a riskier asset. Higher the Sharpe ratio, the better a fund's return relative to the risk it has taken on. The idea is that you need to be compensated for any additional risk that you take on by not investing in the risk-free asset. So you have basically it's based on your risk-free rate, what is your returns. So with this, we conclude today's class, and we'll continue tomorrow on a few of the other topics that we have. But meanwhile, whatever we have practiced, we practiced 3 things today. We completed 3 things today. One is our efficient frontier model. Second is portfolio optimization using constraints and objectives. And number 3, we have completed the CAPM and the Sharpe ratio model. All of you practice this. I have sent the code to Sachin sir, and you can take it from him and try to understand what the code is doing and why.
Yes, sir. Yes, sir.
Tomorrow we will cover some time series aspect, as well as we'll see how back testing actually works.
Okay.
And maybe a few other things. So have a nice day, guys. So
Okay, thank you so much, sir. Thank you. And looking forward for the same learning tomorrow as well. So thank you so much, Pranvesh, sir.
no problem.
See you tomorrow at 2:30.
Yeah.
Thank you so much. And participants, we are going to have Pranvesh sir's session tomorrow as well at 2:30. And our first session will start at 10 a.m. as usual. And tomorrow will be having Dr. C.P. Gupta. He's a professor of finance and business economics from Delhi University. So he is going to take session on data visualization and data presentation. So he will be there with us for session 1 and session 2 as well. And for the session 3, we will be continuing Pranvesh sir's session tomorrow as well. And feedback link is already being sent to your WhatsApp group. So kindly fill that feedback form, and whatever files sir is gonna send us, that will be shared with you. Thank you so much. Thank you so much, Pranvesh sir, and thank you so much, dear participants. Thank you so much. See you all tomorrow at 10 a.m.
Okay.
Thank you. Thank you, sir.